Gold, an enduring symbol of wealth and stability. But in 2025, does it still hold its shine as a top investment choice? Today, we're diving deep into whether gold is a smart investment right now, using technical analysis, comparing it to the US dollar, and offering clear recommendations you can act on. Gold has had a phenomenal run this year. As of May 5, 2025, it's trading around $3,312 per ounce. That's a major leap from previous years, and it's not just random market noise. A big part of this growth is being driven by central banks. They've been buying gold consistently for 15 straight years now. But what's interesting is the pace of buying is accelerating. In 2024 alone, banks added over 2,700 tons of gold to their reserves. Why? Because they're looking to reduce reliance on the US dollar. And gold offers a politically neutral, tangible store of value. Let's break down the technicals. If you pull up a candlestick chart of gold, you'll see a clear uptrend. Gold is trading comfortably above both the 50-day and 100-day simple moving averages. That tells us investors are confident and the momentum is on the upside. In fact, the 50-day moving average is acting as dynamic support, meaning when the price pulls back, it tends to bounce off that level and keep rising. Zoom in a bit more and you'll find the RSI, the Relative Strength Index, is hovering in the 60 to 70 range. That's a bullish signal, but importantly, it hasn't crossed into the danger zone of overbought territory. This suggests there's still room for upward movement before a technical correction is likely. If prices do pull back, watch for key Fibonacci retracement levels at around 1,120 and 1,140. These are historical support zones where buyers tend to step in. Now, let's talk about the US dollar. Historically, gold and the dollar have had an inverse relationship. When the dollar weakens, gold tends to rise. Since 1973, during US dollar bear markets, gold has returned an average of 133%. In contrast, during periods of dollar strength, gold has actually declined about 9% on average. But that pattern has been shifting recently. Central bank demand and geopolitical uncertainty are giving gold a leg up, even when the dollar is relatively strong. That's a big deal because it means gold is no longer just a hedge against dollar weakness. It's becoming a preferred reserve asset in its own right. So how can you actually invest in gold? You've got a few main options. One of the most popular is the SPDR Gold Shares ETF, ticker symbol GLD. It's one of the largest and most liquid ETFs in the world and directly tracks the price of gold. If you're looking for a slightly lower cost option, iShares Gold Trust, IAU, is a great alternative. It does the same thing as GLD, but with a lower expense ratio, which adds up over time, especially if you're holding long term. If you're looking for more growth potential and are okay with taking on more risk, consider gold mining stocks or ETFs. VanEck Vector's Gold Miners ETF, GDX, holds a broad basket of large gold mining companies. For even more upside, but more volatility, there's GDXJ, which focuses on junior miners. These companies tend to outperform when gold is rising fast, but can get hit harder during corrections. That said, there are risks. One major one is interest rates. When rates rise, gold can lose some of its shine because it doesn't generate yield. Investors might shift into bonds or cash, which become more attractive. Also, if geopolitical tensions ease or inflation cools off significantly, demand for gold as a safe haven could drop. Still, forecasts are bullish. Goldman Sachs recently put out a price target of $3,700 for gold by the end of the year, and as high as $4,000 by mid-2026. In a high-risk environment, think global conflict or severe economic downturn, they believe gold could even hit $4,500. On the more conservative end, State Street analysts expect gold to range between $2,600 and $3,100 throughout 2025, with a bullish scenario hitting that $3,100 mark. So where does this leave us? If you're considering adding gold to your portfolio, now could be a good time to start building a position, especially if you're aiming for long-term protection against inflation, currency risk, and market instability. Gold isn't about short-term gains. It's about preserving value over time. For most investors, a 5 or 10% allocation of their total portfolio in gold or gold-related assets can be a smart hedge. If you're more conservative or skeptical of the broader economy, going higher, maybe 15%, might make sense. Keep in mind, you don't have to go all in at once. Dollar cost averaging into gold over a few months can help reduce your entry risk. And remember, gold should be just one part of a diversified investment strategy. It's not a one-size-fits-all solution. In summary, gold's 2025 outlook is shaped by a unique mix of technical strength, central bank demand, macroeconomic uncertainty, and evolving global dynamics. Whether you're a seasoned investor or just starting out, gold offers both stability and opportunity. But like any investment, it requires strategy, timing, and discipline. Thanks for watching. If you found this breakdown helpful, don't forget to like, subscribe, and hit the bell icon so you don't miss future updates. Drop a comment below. Do you think gold will keep rising, or is it due for a correction? Invest wisely, and we'll see you in the next one.